What is going on, guys? Thanks for your time and watching. This is Baro, aka Invest Mentor. Today is September 7th, Tuesday. And yeah, as usual, like we're gonna just go through some of the just like news that we have like in the US stock market and financial market, and we're gonna have a review to some of the stock tickers today in the live stream. And before everything, just as usual, we're just gonna mention again, this is the channel, the live stream, like short video here are created for entertaining, educational, informational purpose only. So please always do your investment research and due diligence for your, and be responsible for your P&L. Okay. So like I mean, like, what's been like going on recently in the global financial market? Like recently, like last week we had in the US we had the new like a job report for August, and the job report was weaker than expected, just making the market investors like thinking there might be a chance the Fed will delay the taper, and then the stock just like rally again, like last week. So we just had a stock market, US stock market, like record higher and higher. Just had another breakout last week, and but the thing is like this: the inflation has been like worsening in the entire 2021 till so far, and so it seems that the US stock market just like keep like going up, like no matter what, right? So no matter it's a bad news or good news, the stock market just like keep going up. And last week, last Friday in the live stream, we just try to figure out the reason why the stock market just like keep going up, because there are too much cash. You're too much cash. Like in the market, there is a capital flood. It's a US dollar flooding, US dollar flooding like everywhere. And last Friday in the live stream, we also caught the comments from the new bond king, Jeffrey Gunlach. He's been worrying about, I mean, like his recent interview, he's been worrying about the worsening inflation, as well as the declining of the US dollar, the global the reserve status. And how does he relate to, how does he have anything to do with our stock trading investment? Inflation or US dollar declining may not have immediate impact on any single stocks we are trading, or our entire portfolio, like just risk management and all that. But in the mid to long run, in the we are not sure what's like what's really mid to long run. I mean, in terms of this, it can just like happen, anything bad like happen, this month or next quarter or next year, or maybe that will be something, just bad like coming up in next like 2 to 3 years or even longer. We don't know. But inflation is just a negative ongoing trend, and also like the declining US dollar is also another negative ongoing trend. For us as US stock trader and investor. So we also gonna like just have some more discussion about this topic today. Okay, so before that, let me like just turn on the music a little bit, and then thanks for some of the chat here, the audience. Thanks for Snowy Sophia again. Yeah, thanks for coming. So you say, is the unemployment rate okay right now? The unemployment rate, the labor market, the job market actually has been like recovering quite well in just like since the COVID-19 low, like in March 2020 last year. The labor market, I mean the stock market and the labor market just like dropped, like just went really bad like in March 2020 last year. But it just since then it just had non-stop recovery, non-stop rebound. Just in the past like 1.5 years, the labor market, the non-farm payroll and the weekly jobless claim has been reported really positively in the in the past. And but until recently, the job market recovery is a little bit cooling down. But we have been like wondering how come, like in the pandemic, in the COVID-19 pandemic, like just like a lot of people just got like a social distance, just got locked down at home, and how come we can still have such a strong economic recovery and job market rebound? Yeah, that's a good question. We talked about that like just in the live stream last Friday. That's also mentioned in the recent comments of the new bond king, Jeffrey Gunlach. It says like right now, so the debt to GDP ratio, the US debt to GDP ratio is 125%. Just oh sorry, so we probably have some echo here. Let me just make some so yeah, I think the voice should be good. Please let me know if the voice is too loud or too quiet, if it's echo or it's totally fine right now. Yeah, thanks for your Thanks for your reminder. And the please. Sorry. Let me give me a second. Trying to. Please give me a second. So last Friday, why don't we do this? Just let's just start it from to go through some of the like interesting article I just I just got today, you know. Yeah, so we know that, like, you know, so it's about like 2 minutes before the US stock market open, but like earlier today in Asian market, you know, we can see that Asian stocks up, but you know, because of what? Because of the last week we had a weak US job report, so the, you know, as mentioned, the market investor just expect, you know, the Fed will delay the taper, you know, to so meaning we will keep like having the, you know, the capital flooding in the US stock market and all over the world in the global stock market. So the stock, I mean, US stock market and the Asian stock market just like, you know, picker up today, but it says like aftershocks from disappointing US job report remain, like some investor will still think that, you know, because the, you know, the job market recovery is like a cooling down, it's like turning weak right now, so that might have some like a negative effect. So that would be a mix of sentiment. So please check into that and just give me a second. All right, guys, sorry for the pause, sorry for the technical issue. on my OBS system, but yeah, I'm just back. And the right. So okay, so this is good. So what about this? Like, okay, so the market is open. So what's going on? What's going on for the tickers? We have been looking at. Yeah, we can see that Bilibili is up. Like the US market just like open for like 2 minutes, and Bilibili, the Chinese stock, just up for about 8%, and KE Holding is up for about like 6.3%, and the Fudu Holding is up for about 6%, and China Liberal Education is up for about 5%. And China, okay, so we can see like, you know, some of the major top runner in my watch list or Chinese stock. Okay, so meaning at least like so far, I mean, the first like 2 minutes of today is like saying, you know, just my recent allocation to, you know, just reallocate some of the US stock into Chinese stock. It's a correct decision, right? Correct decision. So because like Chinese stocks has been like, you know, just performing better, relatively better than a lot of the US stock, better than those like you know, super US stock mover, like, you know, meme stocks and all that. Because of what? Because we talk about that, like you know, because like 2 weeks ago, like few weeks ago, 1 month ago, we've been talking about the China crackdown, like, you know, China crackdown on technology company, you know, just with a tremendous ripple effect, like all over the entire technology industry, like, you know, started from like you know, Alibaba, like you know, and the end IPO overhaul, and you know, just saw like you know, just you know, some of the cybersecurity, you know, just investigation into the Didi IPO, right? And they also have the crackdowns, just like make the education company non-profit, right? So but after all those crackdown, after all those like crashes in Chinese stock, like we talk about that. It's you know, it's highly likely just a scam. And it's not like we don't know if it's a scam. Like, you know, even if it's a scam, we don't care. Like the only thing we care is like how we can make some profit by trading and investing in those Chinese stock, right? Because the price of those Chinese stocks, we're not talking about those penny Chinese stock. We're talking about those like, you know, just the giant, the corporate giant Chinese stock, like Alibaba, like, you know, we talk about, right? This we have a category, we have a, you know, just please look into the left of the watch list in my trading screen. Like we have a list of those like Chinese like Internet of Things company, you know. Obviously they're all green today, you know, other than Sohu. Okay, they're the, you know, top mover today. So okay, so yeah, sorry, back to Snowy Sophia's question. You know, the unemployment rate was, you know, the job market was recovering strongly, super strongly, until like, you know, last week just like turning weak. So, you know, like, you know, in every turning point, in every, you know, economic data or like, you know, just like financial events, the turning point could always be good or bad, right? So, you know, at that like very moment, like, you know, a lot of investors say, oh, that would be good for the, you know, stock market. So the stock market is like keep going up, and but some investor will think, oh, maybe like if the you know, the job market like keep like, you know, just like weakening, like what will happen? So some people, some investor will start like selling off. So the market would just like, you know, just have a, you know, just like turn into like a choppy, like a consolidation, you know, before the next clear direction we can see. But that's for, you know, all about this. It's just for like trading, right? Like if we do like trading, if we do like intraday trading, we do like, you know, we trade for like you know, few minutes or a couple hours or a few days, we will pay more attention to such a, you know, detail. We will just like use a microscope to watch closely every day to see what's going on with those economic data, like unemployment rate and all that. But in the long run, if you are an investor, if you are doing investment for like 2 years, 3 years, like for investment strategy, we look at a bigger picture. We look in the longer term, right? So Snowy Sophia, I'm not sure like what kind of like strategy you're managing. You focus more on like trading, or you focus more on like investment? Please let me know so we can discuss further. And you know, I will be really thankful if you would like to share some of the strategy or ticker stocks you are holding and what's your strategy, right? So what do you think about the US keeps on printing money? Yeah, thanks for the question. I mean, that's a big question as well as a big issue, right? Just okay. So while the market just remain the way it was like at the opening, let's let me see. Oh, let's look at this. Like just your, I mean, to Snowy Sophia's question. Okay, so this was the article we just talked about. I mean, that's a command, like, you know, commands like made by the new stock king after Bill Gross. You know, the new stock king's name is like Jeffrey Gundlach. He will say, we're running our economy like we're not interested in maintaining global reserve currency status. Okay, so I in the live stream last Friday, and you know, today I copy and paste this article like in the, you know, just description box down below this video. So please check into that for more detail when you have time. And please never forget to hit the like and subscribe button. Hit the like and subscribe button. You know, just by your in your convenience. Okay, that really help us to make this channel and the live stream go viral, and you know, just so we can, you know, keep like improving on it. But anyway, like Jeffrey Gundlach is this guy, right? Looks pretty young, right? But he's like you know, 61 years old. He's the new bond king after Bill Gross, you know, the bond fund manager from PIMCO, right? One of the biggest asset manager in the world. Okay, so but anyway, in this article, in the recent comments made by Jeffrey Gundlach, he's saying, he's like, you know, worried, very worried about the, you know, the warning signs, the worsening inflation, and as well as the you know, the declining, the gloomy outlook for US dollars. So he's moving his allocation. He's like, you know, having some allocation into European market, in some of the you know, emerging market. Okay, because in this article he's saying, like, right now the US government has been printing money. You know, back to the question Snowy Sophia asking, you know, just you know, I mean, the Fed has been printing money, and And do you know, I mean, I was wondering if you know like how much money the government just print. We can have let's have some like you know, just figures, okay? So last Friday in the live stream, we also like use this. You can like check into the you know, description box, and also press the like and subscribe first, and then you know, go into the description box and see the link I copy and paste there. You can see like the major part I want to show is here. You can see like, you know, they just have a very detailed figures into all the like US national debt, US federal spending, US federal budget, and you know, largest budget items like, you know, Medicare, Social Security, and all that. And we also have like US federal tax revenue and you know, all that. But today we mainly want to, you know, if you can see my cursor here, we want to see the figure here, you know, 125.74%. That's the US federal debt to US GDP ratio. Okay, 125.74%, meaning what's your GDP? That's the, you know, that's the gross production. That's the production you can make, right? Including, of course, that's including your investment. For example, if you can make like for example, if you can make $1 million a year, and you use the 50% of that for investment, so your GDP is about like 1.5 million that year. Okay, so it's like 125% of that 125 of that 1.5 million would be your debt ratio, will be the debt you are holding. So that would be like 2 million, over 2 million, right? So that's the thing. And but the ratio is like this. In 2000 dot-com crisis, we had the debt to GDP ratio at about like 56% only. And in 1980, wow, you know, just US just like, you know, struggle to fight like Japan's, like, you know, just like, you know, just you know, Japan at the time, like 1980 was the time like Japanese was like, you know, manufacturing was like, you know, going to be prevalent. To Japanese was going to, you know, just like, you know, catch up the US to become the top one, right? So, but even during that time, the US federal debt to GDP ratio was about like, you know, lower than 35%. And in 1960, okay, 15 years after the Second World War, the debt to GDP ratio was like 52. So obviously, like 30 to 50 was, you know, just all normal. Was a normal, like, you know, traditional. I mean, was a normal benchmark traditionally, right? 30 to 50%. But right now we have like 125%, which is like double or like 3 times, like triple the normal benchmark we had in the past couple decades. Okay, so that's how crazy, you know, our government, US government, and the corporate just like, you know, borrowing, just like, you know, how poorly we're in debt right now. And this, you can see like US corporate debt has climbed to an all-time high in the decade since the financial crisis. You can see, okay, the debt, you know, the upward slope, you know, it's, the debt keep like increasing. And you can see this is like United States government debt, you know. It's last time we also talked about that. It's like, you know, in the things like last year, like you know, in the end of like Trump administration, the government just went crazy, could keep like, you know, issuing debt. You can see in just like 2 years, you know, the debt, the US debt has gone like from like 20 trillion to almost 30 trillion right now. You know, that's that's about, in 2 years, US government just borrow the amount of debt, which is the same. The government just like spend like 40 to 50 years to borrow from like 1950 to from 1960 to 2010. Okay, from 1960 to not even 2010 to 2007 and 8, the the US government debt was not even 10 trillion, but right now it's like almost like 30 trillion, and one third of that just got leveraged in the past like 2 years. So that's how bad we're in debt right now. And let's see, okay. So this is like a national corporate, corporate bond. We can see like this is corporate debt. This is a US government debt. You can see how scary, how exciting the upward slope is, and then let's see, this is okay, this is a US private debt to GDP ratio. So you can see that like about like the financial crisis 2008, we have the level at about like 2 to 3, 2 to 4 here, and then like after 2008, like just the private debt to GDP ratio was kind of adjusted, was kind of like calmed down a little bit, but until last year it just like surged over that benchmark again. So that's how bad we're in debt. The government debt, the corporate debt, the private debt. Private debt is the just like personal loan, like car loan, like mortgage, and all that. Like we individual, how much we individual borrow, right? And you can see this is a United States gross federal debt to GDP ratio. This is a US government debt to GDP ratio. Right now we saw that on the clock here, right? It's over like 125%. It's even higher than the level we had, the historical level we had in Second World War. So, and what's the difference? I mean, in Second World War, like US was like super strong. That just the time. This is just a rising time of the US, right? At the time, US was like making so much money, and so it was not a problem to have that much debt to GDP ratio, right? So you can see after the Second World War, the debt to GDP ratio just came all the way back down, because like at the time like US just had too much money to keep, so just like keep paying back those debts, so the debt to GDP ratio to come down. But until like 1980, it just turned into a totally different story. Okay, just our government just started getting into another circle of bad debt, So after that, let's see. This is, you can see, this is S&P Global, S&P 500 Global Index. And what's about the debt to equity ratio for S&P 500? You can see after 2008 financial crisis, that was about 1 only. And from like 2010 to 2020, in the past, like from 2010 to 2014, that 4 years, as the ratio was like much below like 1. It's like from like a 0.6 to 0.8, and then until like recent year, like 2020, we have that like surge like all the way crazy to like a 9 to 18. That's like a 10 to 20 times of the debt to equity ratio those like S&P 500 company got, like compared to what they have like many years ago. This is really a big problem. Our government, our corporates, our citizen, everyone is in big problem of the that issue right now. So that's, back to the question, like Snowy Sophia, you say just how I think about the debt, how I think about the money printing cycle. Think about that. I will be right back in just a few minutes. Think about that. Is it good or bad? It's not. I mean, on the surface, it looks like it's really bad, but is it really bad? Is it really bad? I mean, as an American, as a smart, wise investor, is it really bad? Not necessary. Not necessary. I will let you know why. Please think about that first. Is it good or bad to keep, to have this like money flooding, and how we can, stay good through that? Okay, think about that. I'll be right back. Okay, sorry for the pause again. So, what's the further question we have here? Thanks for coming, Michael Barry. Michael Barry is tapering, coming right away. Just as we saw that on the news, like, the government was like, so I think like right now, like, just like everyone, including government, everyone can be, just moving back and forth, up and down, right and left, like whatever. Just, we can change our mind. We can, change our decision. Just like flip around, like overnight, for no reason, right? So because why am I saying about this? Because like, in the past, like, it's 1 to 2 months, the Fed has been turning back and forth between like hawkish and dovish, right? Like the day before they could be really dovish, say, oh, we're gonna do some like, we cannot do the taper so quickly. And later on the next day, say, oh, we have to do the taper right away because of the inflation is getting really bad right now. Good. And just back and forth, right? So but it's the same, right? It's like politicians always do that, right? It's like, Biden, Trump always do that, right? We can talk about why the first day and the second day we can talk about black and whatever, right? And so you say, is the tapering coming right away? I mean, we don't know, but obviously we just have to understand the fact, right? No matter the taper is coming sooner or later, as retail investor, it doesn't matter that much as long as we got prepared, right? Because the taper, I mean the exact day and time frame will kind of like affect those institutional investors and the professional investors, because they have a much larger position compared to what we have. So and a lot of time they're like trading investment performance are counted every day. So that's what, so they have to follow really closely to all those decisions, the changing all those decisions. But like for us as retail investors, I mean retail investors, okay, if I mean we are like a retail like trader, of course we're gonna be really, you know, just we're gonna be really nervous and pay really high attention to all the details, like, you know, watch the market very closely. But as a retail investors, I mean just watch the market. We're not gonna be like, you know, just a professional one, right? We're just an amateur one. So we probably spend like 1/3, 1/5 of our time in investments. So we read some news, we make the decision, right? So so in this way, the taper, I mean, the, I mean, the taper in September, October, November won't affect our investment that much, because we look at the longer run, right? We look at the long run. I mean, we our thinking is about like what will be, I mean, what will be going on next year, 2-3 years, in the next 1 to 3 years, right? So then it doesn't matter if the taper is coming up in 1 or 3 months. Okay, so yeah, so Snowy Sophia, just back to your question. I was wondering like how you think about US like keeps printing money. Like back to your you know, just back to your question. Do you think that's good or bad? And we just say we're gonna have some discussion with that. And I was saying like we can think about that. Okay. So but before that, let's see. Okay. So Seth. So will the like slowdown of like QE cash, the market at this point, will it slow down? Do we crash the market at this point? Okay, so yeah, thanks for your question and thanks for your time. You know, so yeah, just to this question, I mean, like so far we haven't seen any crash caused by the, you know, the slowdown of the QE, right? And but I mean, we're not sure if that will really happen. You know, if this kind of crash will really happen, and if it will really happen, we're not sure if it's gonna happen in the this month or the next quarter. And if it will happen, we're not sure if it's gonna be a, you know, 20%, 30%, or 50% crash. But that's from my 2 cents. I think any crash, any potential crash caused by the slowdown of the, you know, QE or direct government policy. I mean, any crash caused by government policy directly, I mean, wouldn't be too bad, okay? But any crash caused by any government policy indirectly or implicitly may be really bad. You know, just like, you know, for example, like in 2008, I think, from my 2 cents, I think the crisis of like 2008 is somehow brewed, or is somehow just like developed by government policy, right? At the time, the US just allow like people to just like keep having loan and debt, and to, you know, just like, you know, boost the housing market, to have that like subprime mortgage bubble. And then, you know, that's the thing I was going to say. In 2008 and right now, and some people say like right now, like if we look at the increase, the upward slope of the debt ratio, we really look like it's really like we're in 1999, right, before 2000 .com crisis, right? It's kind of the slope is kind of the same, right? It's really steep, right? it's really steep. I mean the upward slope is really steep for the US stock market. And but in 2000 we didn't borrow that much money, but right now it's kind of the thing, like we borrow a lot compared to what we had in 2008. And but the things like that's just from my 2 cents. Okay, what we're talking about, is it good or bad for our government to like keep like printing money, for our corporate to keep like just like raising the debt to equity ratio, for our citizen to keep like just like borrowing, right? Is it good or bad? The answer from my 2 cents is not necessary. It really depends on, I mean, at least it's unnecessary, right? It's not necessary. When it's necessary, it means like, oh, we're fucked. Like, no matter who you are, no matter where you at, we're gonna, I mean, all of us gonna, just got screwed or fucked. But, it's not necessary. And then it really depends on who you are and how you borrow the money, how you do your asset allocation and the risk allocation and all that, okay? Because think about that. Think about like what happened in 2008, okay? Okay, so let's back to the trading screen a little bit. So KE Holding is up for about like 15% right now. It's pretty crazy. Okay, so like and then SoftBank is up about 9%, Clover Health and AMC is up for about 7.5, and the Tall Education is up about 7.3, Futu is up about 7, so Bilibili is up about 6, and Didi is up about 6.4. So yeah. So most of the top runner in the first page of the watch list is still, are still those like Chinese stock. So obviously I will see a lot of, just I don't know, we can call that backlash, or it's a backfire. For some of the investor really against like Chinese, right? So but anyway, they're doing quite well recently. And then what was saying, back to the discussion. When the government keep like printing money, like government, corporate, like individual keep like borrowing, and the crisis will be pretty sure, will be just pretty certain like to come up in the near future. But crash, terrible correction, or crisis sounds like really scary, right? But these are kind of the things in times actually rich people just love this kind of thing, right? Rich people love crash, rich people love correction, rich people love just crisis, because like in every crash, in every crisis, the rich just become richer and the poor just become poor. This is not a nonsense or bullshit I'm like having here. This is just the facts, just happen like over and over again in the history, right? In every crisis, in every crisis, in every crash, in every like a war, in every just turning point, like those like smart people just have somehow, at least they materially become like richer, right? That's the thing. So but how have they made that happen? That's the thing, right? So back to the point, I think I'm like just I'm kind of like just grumbling, kind of like just going too much like up and down too much. So that's back to the point. In 2008 and right now it's the same thing. in 2021, the U.S. government and the corporate just keep borrowing money, and individuals keep borrowing money. So the U.S. dollar, because U.S. dollar was I mean, we had the just like global the reserve status for U.S. dollars. So U.S. dollar, I mean, we can use like U.S. dollar to buy a lot of things from China, to buy a lot of things from Africa, from Europe, right? We can just use U.S. dollar, right? U.S. dollar is a reserve like over 60% in the I mean, it's over 60% of the global reserve right now, and but it's declining right now. But that's how we can keep printing money without pushing the domestic inflation, too bad and too hard all of a sudden. We can kind of like transfer that inflation effect to other country that have a tight correlation with the US. Okay, so at the time we keep like issuing debt, we keep borrowing, we just borrow. It's not like we borrow internally within US, right? It's kind of like the entire US is like borrowing from every country around the globe, right? So we just like borrow. We want to borrow from China, say, oh, China, can you please like, I want to borrow some US dollar. Can you just give me some US dollar? Because we pay China a lot of US dollar to buy a lot of products from China, right? And that's the same thing. We just borrow all the US dollar and make all the US dollar around the globe like flowing back to the US. That's how the stock market just like, keep going up. And then, just our citizens just have enough cash to buy goods to borrow, to get a stimulus check, and turn around to buy things on Amazon. Okay, and that's how we have the increasing debt to GDP ratio. But no matter what, okay, that's how we issuing debt and how we borrow US dollar from every corner around the globe. But later on, no matter the bubble will be there for sure, and the crash will be there for sure. But what will happen? Right? Usually along the way we have bubble through borrowing, and along the way we have that crash. Those rich, because they are rich and smart enough, so they already have a plan, or probably they are in one of the beneficial group with that insight. So they understand when and how and what to sell, right? So they can just they took the profit. That's the way they became rich. And for those like poor, I mean, that's the rich in the US. But for those poor in the US, it doesn't matter either, because a lot of poor people in the US, I mean, they didn't have enough like money, and so sometimes maybe they have money like all of a sudden, and they just like bet, gamble all the money into stock market, and or some of them like just like the middle class just kind of like do some just borrow some just get some like mortgage to get a house, one house, two house, and all that. And then later on, after a bubble, after a crash in stock market and all that, those poor just become lose everything, right? And some of those gambler just wanna in the like option market just like lose everything, right? And then some of those who just use the loan or mortgage to get a house, just got like for disclosure, right? They just out of the market. I mean, the worst would be they just have a just a bad credit rating. But what will happen after the entire event? Who's the biggest loser? Who's the biggest loser? Think about that. I mean, in the entire operation project, right? The we just see the US dollar just like keep flooding from every corner in the world into the US, right? So for example, originally the entire US have only 100 US dollar, and then they want to borrow, so they borrow another 100 from every corner in the globe, so they have like 200 in the US right now. But because of the bubble, so it crashed, right? It crashed, and then the US is not able to pay back to every corner in the globe. So they for the 100 they borrow, they probably can pay like 70 or 60%. So who lose? I mean, who is losing? Who is the loser? Those who lend money to the US, man. Just like what we have in 2008, right? We saw a lot of the, we have that, like, the subprime mortgage investor from Japan, from my home country Taiwan. They at the time they thought, oh, that's a really good risk and return. We have like 10% to invest in the US, like a mortgage, right? We have like 10% return every year. And then it's just like everyone just keep like putting money, buying US dollar, buying US bond. That's how like Citibank, like JP Morgan, Bank of America, that's like everyone in the globe, around the globe doing, right? And that's also what I heard a lot of those, like what I mean, what's that? The wealth management, like a department, their department head in the city, or like Citibank in Hong Kong, in Taiwan, they're having like, recruiting new people to do that, to ask those like, rich people to buy US bond. But later on, we like last Friday, we see US dollar will be declining for another 20 to 30%. So even if there's not a crash, imagine you buy $1 million US dollar bond, and then like later on in 3 years, the US dollar just had a depreciation for 30%. So even if you can have like 5 to 10% return from that bond, so what? No matter what. But a lot of people, that's the charm. That's a charm. I mean, I don't know. That's the attraction. I mean, just a lot of people, just have a very strong conviction to US dollar. That's the advantage we have, right? That's an advantage we have as a US stock investor or US dollar holder. Okay, so that's a little bit too far. So back to the question about like Seth. Okay, the debt is insane, and so soda cookie, US dollar should weaken after tapering. No, US dollar is not gonna be. It doesn't weaken after tapering. Without tapering, US dollar will be weakening even faster. Okay, that's the thing. So yeah, just give me. Okay, so please give me just a second again. Like after I read through all this. So US dollar should weaken after tapering. And this website is really cool. Yeah, I mean, I copy and paste like this site. So I mean, they have some like, just a really user-friendly figures. I mean, I think like a lot of people, just a beginner stock trader investor should, know about. Okay. So yeah, thanks, Seth. That is really insane, but we don't care. I mean, the world is insane, and we just have to, inspect ourselves and work on more with bullish. So gamma, I wonder the government is going to shut down again. I'm not sure, but I thought the government shutdown was just kind of a joke, was just kind of a a show. you know, just, but it's not necessary. And Michael Barry, the rich are rich because they always know how to create debts. Yes, right. I mean, that's really a good one. I mean, that's really a good one because I mean, we know a lot of, you know, just like me, Kevin, another the one of the, you know, most famous uh financial YouTuber, the US financial YouTuber. I mean, it's been saying, like, a lot of people saying, like, you know, if you are, if we are not a beginner, if we are experienced enough, I mean, at the time, you know, at such a low interest rate, we will no experience, we will buckle down to borrow everything we can borrow, right? You know, if we can pay back, we can make a good return payback, that would be great. That's for the rich. And even if we cannot pay back, we just do whatever we can do. And we just, I mean, later on, we just lost everything, just got full disclosure and all that, but we're still okay. So, I mean, it doesn't hurt, right? So, just give me a second, I'll be right back. Right, so sorry for the pause again, and yes, let's see. Gamma. So like well said, and so Wall Street is a soda cookie. Wall Street falls today at open. What do you mean by that? Wall Street falls today at open. Let's see. Sorry, a lot of people saying, like, I mean, like, you know, I don't know why. A lot of people, this is since you know, don't have a really good image, don't have a really good, like, you know, impression on like Yahoo Finance. I mean, Yahoo Finance is I know it's not for like a super like professional, but I mean, it's really user friendly, right? I mean, the reason I like to use it because it's user friendly and it's kind of like collect and organize a lot of information from different sites, from Bloomberg, from, you know, just we can see from Barron, from Reuters, from, you know, Wall Street Journal, from like everywhere, from Market Watch, and you know, from IBD, from all that, and I mean, like to a certain point, they kind of they collect the mostly read articles, right? So and also like you know, CNBC, CNN, BBC, and all that. So I think it's very good. It's very good. It's very reader friendly, user friendly, especially for a lot of the, you know, young generation, young investor, and the beginner investor. Okay, so I mean, as mentioned, this channel, I mean, is a Borrow Investment Choice for entertaining, educational purpose. So we are not going to dive too deep to, you know, to be confused, okay? Because you know, in the world, for a lot of things, we have to be. It's better to stay a little bit superficial sometimes, okay? Yeah, so back to the point. So S&P 500 is down for about 0.45%. Dow is down for almost 0.8%. Nasdaq is down for, it's at a flat right now. Why we have like Wall Street falls today at open. So Gamma say like SPY trading down 35 basis point. So Gamma, are you doing some like a day trading for S&P 5 for SPY? So yeah, what I mean, please share your strategy. I mean, your P&L. I mean, so we can discuss more. Okay. So Soda Cookie, how can we prepare for this? Prepare for what? The Dow is down. I mean, prepare for what? US dollar sounds like the worthy of attention striking. Yeah, I mean, US dollar is definitely, I mean, all in all, in conclusion, US dollar is definitely something we can have a strategy to short, to have a long, I mean, to have a short strategy for 1 to 3 years, okay? I mean, we're not gonna, you know, just press too hard, but short US dollar, a long goal in the next 1 to 3 years, you know, as a long-term, long-short strategy. Or you can also do some like arbitrage trading with that. That's almost certain trend for the future for US dollar, for gold, okay? Of course, you can have different thoughts, you can have different advice. So please let me know if you think differently for US dollar, for the trend of US dollar and gold, okay? So Michael Barry, basically you're bearish at the moment. Okay, so I have been like bearish. I have been like, you know, just actually I have been like bearish, like, you know, just seeing like in the past like 1.5 years. Although the market just like keep like, you know, just like going crazy, but I mean, I think like no one other than those other than those in the beneficial group in the, you know, in White House and in the government and in those like corporate, as a corporate insider, I mean, no one know the U.S. government and the U.S. corporate will keep borrowing money in this way, right? But that just happened, and it doesn't matter, right? Because we're not a corporate insider, we're not the core member of those like beneficial groups, so we always realize, I mean, at the later time, but it's fine. And so back to the point, like Michael Barry, yeah, I have been bearish for a long time, but there's not yet a market correction, not yet a crash yet, but I don't want to be a bad guy. I don't want to hope for a market crash, but the point I have here is just, you know, no matter if it's really a market crash, what if it's really, what if it really happened? You know, we just have to be prepared, right? We just have to be prepared. And maybe I'm kind of like getting old, and right now I would think a lot of time somehow it's better to be more conservative. It's better to be more you know, just like defensive, right? Because like when we're younger, we like the volatility. We like to go up and down. We like to sit on a roller coaster, right? We need to have a, you know, go to like Six Flags to have a roller coaster. So we also want to have a roller coaster in stock market. But I mean, over time, we were getting like 30, 40, 50 on, we're tired of that. I mean, we just want to have a, like a, you know, stabler life, and you know, safer life, right? So because I mean, we're getting like too old to lose everything. So I'm not really bearish. I just wanna, I mean, somehow bearish, but I just want to be more conservative. You know, be more ready to any potential risk. Okay, so yeah, sorry about that. I'm like just like too kind of like talkative again today. And then I just like go over the time we have right now, and I was gonna so let me see what I was gonna have some like article about like why Bitcoin, Ethereum prices are climbing higher, and also like just central bankers are right. This is not your father's inflation. Let's talk about inflation, and also we know that this is also important breaking news, like China just push on with China to push on opening capital market to foreign investors. That's a very important sign. That's very important signs, because I mean this I don't know. I'm not sure if it's a right way to talk about this. I mean, like right now, like because I get too much later information, like massive information in the US from the stock market, from financial system, from economy, from government, from everywhere. But like in China, we have a limited amount of information. But once we got a lot of time, it seems to become a really trending signal, right? And actually, we know that, like, I mean, because of my previous, like, just work, that I know that China has been open the financial market, the capital market, like since 2008. But right now, it's about like 3 years past, and they want to make it harder and open it harder and bigger. And this trend, this sign is definitely we have to look at. Okay, because if you are going to be an investor or trader for China stock market, or if you are already one of them right now, I mean, this will be a bullish, this will be a positive sign for you, because, and this will be a trend. This will be an irreversible trend. I mean, years ago, the China stock market has about less than 2 to 3% of the entire market held by foreign investors, and later on it become like 3 to 4 to 5%, and right now it will keep like increasing. And we know that like in Hong Kong, like in US, we have like over 30, 40, 60% of the entire capital markets are held and invested and owned by like foreign investors. So we can see the difference. So in China capital market, there will be still a big room to grow for foreign investors. It's not a question like if or how foreign investor will invest, right? And it's just a question about like how and how much and when China government will open the market for these foreign capital. Okay, so that's the thing we have to pay attention. And you can see that like George Soros calls BlackRock's China investment tragic mistake. But George Soros is always like anti-China guy, so we don't have to be too surprised about this. But anyway, this is about like George Soros just say like, oh, BlackRock, the the biggest, the top one like asset manager in the world, just had just set up his just became the nation's first wholly foreign-owned mutual fund firm in China a couple months ago. Okay, so George Soros doesn't like it, but BlackRock just entered China market recently, and later on, this will happen to all the just global asset manager, to Pinco, to Investco, to just Morgan Stanley, Goldman Sachs, JP Morgan, UBS, like whatever, and all that, but right now, recently, BlackRock just became China's first wholly foreign-owned mutual fund company. Okay, that's a big news, and that's going to be a trend in the next couple months to 1.5 years in China market. And this global asset manager will carrying global capital into China. And especially back to the discussion, if like the US market really have any crash, the transfer, the migration will be even harder, right? So that's the thing, that's the trend we can pay attention. Okay. So today, I was also gonna talk about the ARK Invest Tesla stock price target may be outrageous, but Elon Musk says it's worth 3,000 a share if they execute really well. Okay, and also like some of the EV stocks under 10 that could be double, and but probably in the next like a live stream or a short video we'll talk into that. And also Intel stock, we have been seeing a lot of the competition, the fight between like Intel, Nvidia and AMD. We will also talk more into that, like Facebook valuation. Okay, so that's the thing I was going to share about. We don't have enough time. I already gone over time limit, but yeah, thanks for the gun. Yeah, hi Barra, what do you think about Honda real estate? Honda real estate, oh, that's a Chinese one, right? Actually, I just heard that was in trouble of the debt, but I haven't got the chance to pay much attention to that, and I will do some like research and investment into that, and answer your question in the in the comment box. Okay, so please, just like and subscribe and leave your comment and thought, and we will have more discussion in the in the comment box down below this video, and we can also talk about Honda real estate next time in the live stream next this Friday. So yeah, so once again, it's like July, it's September 7th, and I really appreciate your time and watching. And obviously I have like gone over the time, and let's have a quick over. So today the US stock market just fluctuating at a record high level. S&P 500 is down for about 0.37%, and Dow is down for about 0.78%, and Nasdaq is about at a flat. So we talk about inflation, we talk about the debt, the US government debt, the corporate debt, and we talk about a lot of potential issue, the US dollar decline, and the potential migration between US stocks and the Chinese stock. And yeah, so please let me know, and please never forget to hit the like and subscribe button, please, and leave any of your thoughts and comments so we can discuss further. And yes, once again, I appreciate your time and watching, so I will see you in the next one. Peace.